here's the direct method or the direct question. Let's say you and I are friends, Matthew, and we've been friends for a while, and we're having coffee or breakfast. And then in the midst of that conversation, I simply say, Matthew, by the way, is your investment capital or your retirement funds getting a safe and high rate of return? Are you happy with the returns that you're getting these days in the market?
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Today we're unpacking what really happens when the bank says no, and what changes when agents know there's more than one option. Today's conversation matters because more deals are falling apart after they go under contract, and most agents were never taught what to do when that happens. Joining me today is someone who spent decades in the world of private money and alternate funding. He's widely known as the Private Money Authority. He raised millions in private capital and helped agents and investors fund deals without relying on banks. Jay Conner, welcome to the show.
Matthew, thank you so much for inviting me to come along and talk about what I'm so passionate about, that being private money, private lending. The reason I'm so excited about private money for real estate deals is because since I started using private money to fund my real estate deals all the way back in 2009, I've never missed out on a deal for not having the funding. And this one strategy, when someone masters this system of attracting the private money, no chasing, no begging, no selling, no persuading, it's really the most important strategy when it comes to having the funding for a real estate investor, for sure.
Take us back to the first time, when the bank said no, right? What was the moment you realized that you couldn't trust that system and it wasn't helping you save the deal?
Oh, I remember, Matthew, like it was yesterday. It was January of 2009, quite a few years ago. So from 2003, that's when my wife and I started investing in real estate. From 2003 until January of 2009, the only thing I knew to do was go to the local bank or the mortgage company and apply for loans, apply for lines of credit. I'd never even heard of hard money, didn't even know what that was. And so for those first 6 years, that worked out okay. But I mean, it was traditional funding. They made the rules. They set the interest rate. They set the length of the note, the loan to value and all that stuff. And that worked out okay until January of 2009, everything changed. For the better, I might say. But I called up my banker in January of 2009, and I had 2 houses under contract to purchase. And I learned on that phone call, Matthew, that my line of credit had been closed with no notice to me whatsoever. I thought I still had a line of credit. So called up my banker, told him about these 2 deals. Well, I learned over the phone like that my line of credit had been closed. And I said to my banker, his name was Steve. I said, Steve, what in the world are you telling me? My line of credit is closed. We've been doing business for 6 years, always made my payments on time. We got a great relationship. I said, why are you telling me that my line of credit is closed? And he said, Jay, don't you know there's a global financial crisis going on right now? I said, no, but you just gave me a global financial crisis. I don't have a way to fund my 2 deals. So I hung up the phone. And Matthew, I sat right here at this desk and I asked myself a very, very important question. And the question starts with the word who, not how. The question I asked myself was, who do I know that can help fix my problem? And by the way, these people running around saying every problem's an opportunity, I want to throw up. I didn't have an opportunity. I had a problem, right? Let's face the facts. Now, the problem became an opportunity, but at that moment in time, it was a problem. So I asked myself, who do I know that can help fix my problem? I immediately, Matthew, thought of a good friend. His name is Jeff Blankenship. At that time, he was living in Greensboro, North Carolina at the time, and he was investing in single-family houses. So I thought to myself, well, maybe Jeff can help me with my problem. So I picked up the phone, I called Jeff, I told him what had just happened and my conversation that I had with my banker. And Jeff said, well, welcome to the club, Jay. And I thought to myself, well, I'm not sure I want to be a member of that club, but what club are you talking about, Jeff? He said, well, that's the club of having the bank close your line of credit. He said, they closed my line of credit last week. I said, well, how are you going to fund your real estate deals? He said, well, have you ever heard of private money? I said, no. He said, have you ever heard of self-directed IRAs, to where an individual that's got a retirement account can move that money over to a self-directed IRA company and then loan that money out to us real estate investors, and the interest we pay them is either tax-free or tax-deferred. I said, Jeff, I don't have a clue what in the world you're talking about. I said, what's private money? He said, well, he says, I'm not exactly sure. He said, but there's this gentleman down in Jacksonville, Florida, by the name of Ron LeGrand. I said, who's Ron LeGrand? He says, well, I'm not sure about that either. I said, well, why is that important? He said, because Ron LeGrand says we can get a lot of private money for our real estate deals really, really fast. I said, okay. So I went to my first real estate investing conference 6 years after I'd been in the business to learn about private money. And Matthew, oh boy, did I learn about private money. I came back here to Morehead City, North Carolina, and I put my opportunity together. And then what did I do? I put on my teacher hat. My teacher hat says private money teacher. And I went about offering my opportunity of how ordinary people that's got lazy money, that's not working for them, how they could become a private lender.
Before we jump into that part of it, let me ask you too, for those who don't fully understand yet, can you explain what's the difference between hard money and private money? Is it the same thing? And let's dive deeper into that part of it where you start learning about private money, and how is that different from traditional banks? Because if a traditional bank said no, doesn't a private money gonna say no?
So that's a great question. There's a big difference between private money and hard money. Hard money is typically institutional money. It's a broker of money. The hard money lender has gone out and established a fund for individuals to invest in the fund, and then the hard money lender turns around and loans that money out at a higher interest rate than they're going to pay the private lenders or investors, and they're going to charge origination fees. In contrast to that, a private lender is a one-on-one transaction between you, the real estate investor or the borrower, and that individual. So as a result, you're not paying points, you're not paying origination fees, because there is no broker. There's nobody in the middle of that transaction. It's directly between you and that individual. So everything that we do here in this world of single-family houses is called one-offs. One-offs. What was a one-off? It means you got a private lender, or maybe two or three, that are loaning money on this particular deal. They're not investing their money in a fund. And so they're going to get the same protection as the local bank. They're going to get the promissory note, the deed of trust, or the mortgage. They're going to be named on the title policy as an additional insured. They're going to be named on the insurance policy as a mortgagee. So think of the private lender as the bank. The private lender doesn't own any of the property. It's the same type relationship as you, the borrower, would have the bank, but instead it's an individual.
Nice. So for example, who are private money lenders?
So private money lenders are ordinary people. I mean, my private lenders are retired school teachers, police officers, civil service workers. I've even had private lenders that were minor children that inherited money from grandparents at their death, and they became a private lender. So there's three categories as to where you find private lenders. The first category is what I call your warm connections, your own network. All these people are in your cell phone. They're in your cell phone. They're in your social circle. Who do you go to church with? Who do you play golf with, right? Who do you see on a regular basis? Co-workers, if you still have a day job. And then there's your professional circle in this first category. Who's your CPA? Who's your attorney? We see these professionals, they are gatekeepers of all these other people that have money, in addition to them having money, right? And so that's your warm market, your own connections. And the second category is what I call your expanded market. If you're going to scale your business, sooner or later, you're going to run out of your own connections. So how do you expand your warm market very, very quickly? Well, you get involved in organizations such as Business Networking International. That will blow up your warm market connections very, very quickly. And then the third category of private lenders are existing private lenders. These are individuals that are already loaning money out either from their investment capital and or their retirement accounts to real estate investors. Well, where do you find those people? Well, one place to find them is at self-directed IRA company networking events. Did you know over 70% of account holders at self-directed IRA companies want to loan real estate investors money? They want to be passive, right? They don't want to go find deals. They don't want to negotiate deals. They don't want to oversee deals. But there's something different about that third category. They already know what private money is. They already know what private lending is. You're not putting on your teacher hat, teaching them about private money. They already know what it is, and they may already be spoiled as to the amount of interest that they are collecting. The great thing about
that too. For example, let's say I'm a new investor. I'm going to buy my first investment property in any city. Who do I go to? Do I go to, do I first go to like traditional banks to try to do that? Even though I'm a new investor, I don't know how to do fix and flips. I'm learning. Or do I go straight to private money and start asking, my mom, dad, my parents, my cousins, family, friends? Or do I start going to networking events where I can meet these private investors who already know what private investing is, and how do I figure out the different guidelines or like the amounts they're asking, the terms between each of them? Are they the same, or how do you start figuring this out as a new investor?
All the terms are the same. So remember, you're a teacher. You're offering an opportunity. So for example, and don't have a deal in the midst of that conversation, because if you do in that initial conversation, you're already sounding desperate. Right? So first, we just want to share the opportunities. So all of our private lenders get the same thing. So the terms, 8%, and that's an annual percentage rate. I've been paying my private lenders 8%, the same thing ever since February of 2009. The length of the note is the same. The length of the note is either 2 years if it's investment capital, just liquid investment capital. It's 5 years if it's retirement funds, because they don't want that money back anyway. They just want to keep that money, invested. The frequency of payments, and it's interest-only payments, by the way, the frequency of payments depends on the private lender's objections. Or their objectives, rather. Some private lenders need monthly income because they're subsidizing their retirement income with this income. Some private lenders, they just want the interest to accrue. They just don't want to even mess with the payments. And then when the property cashes out or sells, then they get all their principal loan amount back, the principal amount, along with the accrued interest. So, that becomes whatever their objective is. So all the private lenders there's no negotiation. Remember, there's no negotiation. These people have never heard about private money or private lending or self-directed IRAs. So I'm educating them. Here's the opportunity. And when they compare 8% to getting less than 0.5% in a savings account or 3% in a 4-month CD, that's an annual percentage rate, by the way, 3%, and then compared to 8%, they're all excited.
Okay, so let's talk about that too. Let's pretend I'm a new investor, and the first person I want to ask is a friend. How would I ask him to do a private money loan?
Well, I'm not going to ask him to do the loan. I'm certainly going to bring up the conversation either using the direct method or the indirect method. So how would I start the conversation?
Yeah.
And by the way, I've put together a $1 million private money $1 million script collection recently. There's 12 scripts that answers any question that a potential private lender has. So here's the direct method or the direct question. Let's say you and I are friends, Matthew, and we've been friends for a while, and we're having coffee or breakfast. And then in the midst of that conversation, I simply say, Matthew, by the way, is your investment capital or your retirement funds getting a safe and high rate of return? Are you happy with the returns that you're getting these days in the market? And shut up.
Yeah, and I haven't thought about it, but for me, I'm getting like 3.5% on the bank side, and then I invest a little money in stocks, for example, and then the rest just sits in my retirement fund.
Right. So when you the answer to that question, see, all we're looking to do with that question is diagnose if who you're talking to has got a problem. That's all you're doing is diagnosing. So when you say you're getting 3%, then that opens up a conversation about how I'm paying my private lenders 8% annual percentage rate safely and securely. So I just drop that seed, see if that sounds interesting to you. And if that sounds interesting to you, then, I share, how you're protected and all that. But if you came back to me with that question and you said, yeah, last year I earned 12% in the stock market, then I just diagnosed you don't have a problem. I'm not going to tell you about private money. If
Yeah.
you're getting 12%, I'm then going to say, well, man, Matthew, tell me what you're investing in. I want to learn about that. So I'm not even bringing up private money because I just diagnosed you don't have a problem.
Yeah, and they're making more than that right now, and whatever their risk is. But at the end of the day, if they were averaging 12%, and you say private money's offering 8, so let's say, for example, okay, hey Jay, can you tell me more? Like, what do you mean you're offering 8%? And like, what do you mean my capital is safe? Like, how does that work?
Right. So how it's safe means that I'm not borrowing unsecured money.
Okay.
In other words, I'm just not going to give you a promissory note and I'm going to promise to pay you 8% for whatever length of time. In addition to that, I'm also going to collateralize the note by giving you, in North Carolina, it's a deed of trust. In Texas, it's a deed of trust. Most states, it's called a mortgage. And that's your legal recourse. If I don't pay you, the property does. In fact, you make more money with that property than the interest I would pay. But we know private lenders don't want to mess with the property. They don't want to mess with that. They want to be passive. And I'm also going to name my private lender on the insurance policy, the property and casualty insurance policy, as the mortgagee. That way, if there's ever a claim against that insurance policy, then the insurance company is going to make the insurance check payable to my private lender, just like it would be if they were a bank, and to my company as well. And then in addition to that, I'm actually going to name my private lender on the title policy as additional insured in case there's any title issues down the road. I'm not going to borrow more than 75% of the after repaired value. So it's a very conservative loan to value. So we're building in all these protections for our private lenders, just like the bank requires.
Okay, and let's dive a little deeper than that. Let's say, for example, I'm going to use $1 million as an example in San Francisco area. That's just a basic bare minimum, not even. But like, okay, hey, Jay, I can only give you $500,000 and I'm open for the 8%. How are you going to get the other money now? Then how does that work with me? Am I involved with the other person? How about liability wise?
Right. So the private lender is going to be disclosed on the promissory note what position they're in. So with a lot of my houses I do around here, 500,000 would be plenty enough money, if not more, needed for a particular deal. But I have some private lenders that don't have 500,000. They've got lesser amount of money than that. And so then we look at what's called total loan to value. Total loan to value. And total loan to value means you're going to take, if you have more than one private lender being secured by the same property, then you need to add those notes, those loan amounts together and divide by the after repaired value of a single family house. And you don't want that total loan to value to exceed more than 75% of the after repaired value. Now, I didn't say 75% of the purchase price.
Yeah, of the after
But no
repaired
more
value.
than 75% of the after repaired value. So for example, let's say I had a after repaired value single family house of $400,000 after repaired value. And so I can borrow up to $300,000, that's 75% of the after repaired value. But I might be buying that property for $200,000 because it needs renovation.
Yeah.
Maybe it needs $50,000 or $75,000 in renovation. So if I buy it for $200,000, I can borrow $300,000. Well, that's $100,000 in what's called excess cash to close. So I can bring home that $100,000 excess cash and use that money for carrying costs, renovations, etc. And then I still haven't borrowed more than 75% of the after repaired value.
Okay, and let's say this. Now you have two different borrowers helping give you money for the property, $400K, and if somehow you defaulted or there's a fire casualty issue, who's first on the loan? Is it both of them split by the percentages? And how does that work?
Okay. So disclosing on the note is who's in first position, who's in second position. So we used a larger amount of money for the purchase. That's in first position. And then smaller amounts of money that we use for rehab, that would be in a junior lien position.
Yeah, so basically something happened, the first person gets paid first, whatever amount. If there's any leftover excess money, it'll go to the second person.
So the way it works is it depends on if someone's having to foreclose, right?
Yeah.
So the junior lien position is at higher risk than first position. So if a junior lien position is going to foreclose, then they have to inherit the senior position, right? They have to inherit that note. That's why we pay our junior lien positions 10% instead of 8%. But the good news is when you structure these deals the way I structure them, in all these years, 15 years, well, I've been doing private money since 2009. So since 2009, 15 years, every one of our private lenders has received 100% of their anticipated income because of the conservative way that we buy these properties and the conservative way that we borrow money.
Okay. That's good to hear. I'm glad 100% is not easy nowadays, especially with all these properties, insurance issues going on with the environments, you know? It's tough.
Exactly.
Okay. What happens? Is there any like prepayment penalties? Let's say you fix the house in 1 month, you flip the house in 1 month. Is there any prepayment penalties, any points and things like that goes on for the both parties?
So there's no prepayment. So first, let's talk about the private lender. A lot of these programs, if they call the note due early, there could be as much as a 5% penalty. Like if they invested or borrowed or loaned out $100,000, there would be a $5,000 fee if they called it due early. But in my opportunity, there is no prepayment or there's no calling it due fee because I just want to keep it simple for them to do business with us. On my side of the table, for borrowing the money, then in that case, as an incentive for the private lender to do business with us and to loan us money on our deals, we promise to pay a minimum of 6 months of interest on every deal, even in the unlikely event we cash out early.
Okay.
Prior to that 6 months. Because, you know, the private lender, they don't want to get paid off in 2 months or 3 months or 4 months. They want to be earning the money.
Nice. Yeah, that makes total sense. And you having that into your contracts and the fact that you have a 6 month payment period where you're going to pay the first 6 months, they know they're getting the minimum of this amount. And your project might take a year in general, so you kind of have it calculated. But in case you were to finish early for some reason, then you have that kind of minimum basis where they can get paid. And then they're probably happy to go on to it. Let's say this, you're a new investor and you haven't even done a flip yet. You haven't done construction deal loans and having to do like, you know, fix and flips. What kind of qualifications would they need to work with you guys or to work with any private lender?
Well, first of all, if they've never done a deal before, my strong recommendation is to work with somebody that's got the experience, right? Make sure the deal is being structured correctly. And I've got thousands of students and mastermind members all across the nation that have never done a deal before, but they worked with me directly to make sure that deal was structured properly. And I've got lots of students that have raised millions of dollars in private money and had never done a deal before they started raising the money. But how did that work? Well, they were working with me directly, so they were able to leverage my experience, leverage my credibility on getting the private money raised.
Okay. Let's talk about this too. How do real estate agents come into play with private money, and how can we help agents understand how to work with their clients and how to give your clients more options between traditional money, hard money, and private lending, and how to guide their clients to understand, hey, you know, I know you're going to buy this property as an investment property and you want to do fix and flips and you have some construction experience. I actually know a private money lender named Jay, and, you know, he can show you how we can fund deals using this method instead of going this route and paying, you know, these additional points. This may make more sense.
Right. I think the quickest and easiest way, and I'm glad you brought this up because most real estate agents and realtors don't even know about this world of private money. They've been exposed to traditional financing. And so what I would recommend is for realtors and real estate agents to share my book, which is so easy to read. My book is titled Where to Get the Money Now. Subtitle is How and Where to Get Money for Your Real Estate Deals Without Relying on Traditional or Hard Money Lenders. And, you know, if I were a realtor or real estate agent working with investors, I'd get a supply of these books and hand them out to my clients and say, hey, here's a way for you to get funding for your deals that you don't have to rely on institutional money. Now, the book's $20 on Amazon. Don't give Amazon $20. I'll give out a URL to where the book is free, just covers shipping and handling, and I'll rush the book out. But that's the first thing I would do as a realtor that is working with investors, real estate investors wanting to invest in single-family houses or duplexes or quadplexes, is I'd get this book, Where to Get the Money Now, and share the information with them. You can pick up the book at www.jconnard/book, and I'll rush it right out, 3-day express.
Let's think about this too. Let's say a agent is currently in a deal and they're doing a traditional loan and they have a 30-day close, and they suddenly find out on day 17, 21, the lender says, oh, we can't do the deal. What would you do? What would you recommend the agent does?
Well, the worst time to be raising private money is when you need it for a deal.
Yeah, exactly.
That's why I always say, get the money lined up first. Get the money lined up first. There's always going to be deals. There's always going to be deals. So I practice and preach, get the money lined up first before you're even making an offer on a property, and then you're not going to have to worry about that traditional lender walking away.
And I think too, when you think about it this way, I think the more we educate real estate agents and realtors that understanding there's many different ways to do something, and the way, some people always say, no, you can't do it, you can't do this. It's not no, it's like you mentioned, who do I know that can make this work and how do I do it? And understanding like there's more than one method to do anything, okay? Bank says no, doesn't mean it's no, it means no for that bank. Each bank has different product lines, different guidelines, and some banks are more conservative than others. Some are higher fees than others, but as an agent, you want to be the most educated you can as you keep learning skill sets in the industry so that you can provide more value to your clients. So for me, I would say I would love to learn residential lending, commercial lending, private money lending, hard money lending. And I used to be a lender too, so I kind of understand this. And as a lender, you want to say, okay, here's the different products, companies, guidelines, they're all different. Which one does my client fit best in? And if he's doing a fix and flip, I know there's additional risk to be involved. And right nowadays, there's also additional insurance to be involved. And as you start understanding these different guidelines, you can say, hey, just in case, investor, you might want to try this traditional banks because they're going to offer you lower money. But from my understanding of their back-end guidelines and underwriting, you may come up with certain issues that a letter of explanation may not solve upfront for you. So as a secondary backup method, I always prefer to have another private money lender here. And I know your first question, investor, is like, well, isn't there more risk? I pay points, penalties, and fees, and the interest rate's higher. And then what I learned to teach my clients is, yes, some of it can be true, but there's different private money lending versus hard money. And if you were to pay additional costs upfront here at a higher rate, think of it as a short term. Are you borrowing this money for 30 years? Probably not. You're going to refinance. Yeah, I pretty much agree. Okay, how long are you borrowing it? 6 months, like you just mentioned, 6 months payments, or a year? Within that timeline, could you refinance after remodeling? Could you fix the issues? If you had issues qualifying, could you do this in the short term? And what does that cost at the end of the day? Additional 10, 20, 30K more or more? Would that have been more worth it for your investment? At the end of the day, the investment made so much money. Are you going to reduce that just because you go from 8% to a 6% rate? Are you going to lose the difference there for the equity gain? And I think at the end of the day, not all investors realize that difference, and it makes a huge impact. And if the agents can help explain it with the lender, like, hey, this makes more sense. Think about it, right? You're getting this much equity on your flip and the ARV after repair value versus trying to conform to a traditional commercial residential loan. What do you think, Jay?
Well, and people use private money a lot of times if they're planning on holding that property. They'll use the private money for the length of time to purchase it, get the renovation done, and then refinance. A lot of people refer to that as the BRRRR method. Buy it, renovate it, refinance it, rent it out, repeat, right? So private money can be used for short-term and for long-term. I mean, I just checked recently, the local bank rates on commercial is over 8%.
Yeah.
Well, I'm borrowing private money for my flips at 8%. And if I wanted to keep it, I'm not paying any origination fees. Private money at 8% is actually cheaper than commercial rates are today.
Yeah. How much are commercial loans right now paying for origination fees in your area?
2%.
But then private money wouldn't charge you the 2%, and they would just charge you the 8%.
Yeah,
for example,
there's no origination fee or broker fee because there's no broker. There's nobody in the middle.
So why shouldn't agents use them more then? Instead of going to a traditional commercial lender, wouldn't they should be calling you guys, right?
And the thing of it is, as we mentioned, they just don't know this opportunity exists.
Why is that? Why do you think agents and other in the industry don't know that this exists?
That's a good question. I didn't know it existed until 2009 after I'd been in the business for 6 years. So it just comes down to a matter of education. Well, I can tell you one reason most people don't know about it. There's no money to be made from, say, a commission of a broker. Because now there's a commission to be made in the world of hard money, right? But if you're going to raise private money and have that one-on-one relationship with the private lender, then you've just got to know about it yourself. And by the way, in the book that I mentioned, I reveal in the book my entire 20-point benefit that we teach our potential private lenders. The entire program is in the book that you offer private lenders. So by and large, why most people don't know about it is because there's not like brokerages or financial advice. There's no way for financial advisors to make money off of this.
Yeah, and I think even, for example, as a real estate agent, we have in residential real estate, we have a thing called RESPA violations where we're not getting paid by lenders anyways. Our goal is just to guide them to understand, here's your different options you have. You can choose any lender you want. They're getting paid for their service, professional services. We're not involved in that, but we want to make sure you understand that each bank brokerage has their own qualifications, and here's how the house you're buying, fixing, flipping works with that. And even a private money lender, here's the things you can do, right?
Exactly.
Can you take us to a real deal where you actually know, like a client or even yourself, you mentioned before the bank said no. Why was the bank saying no anyways? And then how did you change that thought to be like, okay, the bank said no, crap, what do I do? And how do I get a private money lender to do this deal for us?
Well, I haven't talked to a bank since 2009. So I haven't been told no. I haven't been told no since I got in this world of private money.
Why did the bank say no anyways?
Well, a bank would say no because of your credit score.
Okay.
So private money lending's got nothing to do with the borrower's credit score. Nothing whatsoever, because it's a collateral-based loan, right? The bank might say no because they're going to require a 20% down payment. Well, in this world of private money, there's no down payments ever required. In fact, you always pick up a big check if you're renovating the property when you purchase the property, because it's called excess cash to close. In fact, that's a double check. If you can't pick up a big check when you purchase the property, you're paying too much for it, right? Particularly if you are renovating the property. So, your credit score could come into play. The bank may not loan you any money if you don't have any experience on real estate investing. That's where you want to join hips with somebody that's got experience, and you can leverage that experience with someone else.
Part of it too, for example, even as a new investor, when you're going into a real estate deal with a traditional bank, like you said, the qualifications, who you're working with, are you from the area, for example? Like if you're buying out of state, it's going to be way harder to go traditional banks. Traditional banks will be like, you don't live in the city, you haven't been here, you're buying a property, who's managing it, who's your contractor team? They're asking you for your core 4 people, right? And that's difficult. Private money lending, you get to skip a lot of those things and work directly with a private money lender and figure those out, right? And that's kind of nice. And let's say you're a business owner, you're providing all these LLCs, documentations, proof, and at the end of the day, they can still decline you after you did all this work to do it. Where private money could be more simple. Here's the structure, here's the terms, here's what you want, here's how it works. Are you in or out? At the end of the day, that can make more sense and way easier. And once you're in the property, then you can go back and say, let me go work on refinancing this after I did all the work, got my ARV up to a traditional bank at a lower rate. Makes sense?
Exactly. Well, and another thing is speed. I mean, a traditional bank might be taking 30 days or 45 days to close. Well, speed is king in this business. I mean, all my offers I can close within 7 days. Well, a traditional bank isn't going to be able to close within 7 days. But I can close within 7 days when I'm using private money.
Nice. That's a lot faster. What would you think the seller would say if you had an offer that says 7 days versus an offer that says 30 days?
So most of these properties that we buy are for sale by owner. So a lot of them, they're still living in the property. Well, they can't be out in 7 days. So what do? We offer to close within 7 days. We'll go ahead and purchase the property. and the seller can stay in the property for free for whatever length of time that we agree on, 30 days, 60 days, whatever it is, and we'll close within 7 days, and we'll give them half of their proceeds in 7 days. Then when they vacate the property, that's when they get the other half, the other 50% of the proceeds. That way the seller can go ahead and get money in their pocket. They can have moving money, expense money. And from the buy side, you can go ahead and lock up that deal so it doesn't slip away, because the more time that goes by between negotiating a property and a contract and actually closing on it, all kinds of things can go wrong.
Let's talk about that too. Let's say, for example, okay, that makes total sense, and you can do that. And the owner wants to, he needs 30 days to 45 days to move everything out. The smart thing you mentioned at first was to give them half up front and half later, so that way they can't stay there forever now. Because if they continue staying, they're not getting their other half, correct?
Correct.
Okay. And then you mentioned the part where they get free rent during the time period, 30, 45 days. But at the same time, in your contract, you specifically specified you're only getting paid half up front and half later. So if you want this half, you're going to leave. And once you do leave, then I will give you that half after the fact.
Correct.
Okay. That's smart.
Correct.
That makes total sense because, for example, in San Francisco, which was really, tenant protective, people might stay after the purchase. So even though you have an agreement, those guys specify higher clauses, like, okay, additional terms, like if you don't move out, you're going to pay me $100,000, just for example. Like that way you're forcing yourself to move out and you agree to it. Otherwise, they're going to have to fight, and no one wants to deal with that anyways if a owner shouldn't stay after the fact. But if they forget and say you get free rent, they stay here forever.
Right. Well, in addition to that, if they don't move out by that agreed upon, time frame, then my real estate attorney has been holding that money, those proceeds, in her trust account. She then sends that proceed money over to the clerk of court. So now the seller of that property has now got to appear before the clerk of court and pay extra money to get their money back from the court.
Smart. Let's talk about this too. Since you've been doing private money since 2009, what has changed since then? Like right now this year, has there been changes to private money? And is there anything that private money lenders and investors should be watching out for? And how does it change with all the crisis going on, job losses going on, insurances going on, fire, and things like that?
That's a great question. Well, remember, we as the borrower make the rules. Okay. We're offering the opportunity. We're diagnosing if they have a problem. And you know what's interesting, Matthew? I've been paying all of our private lenders the same interest rate, 8%, ever since 2009, even with the markets going up and the markets coming down, because 8% all this time during 2009 is still, even when you could get 2 years ago 5% in a certificate of deposit, 8% and 10% is still a whole lot better than 5%. So I have just kept my rates of return, the interest that I pay, the same ever since we started.
Nice. That makes sense. And I think, for example, some borrowers will be like, why 8%? Couldn't I ask a private money person 7%, 6%, 5%? Can't I just match a regular banks?
You could. It's your program. It's your offer. You can offer whatever you want to.
But then I think on the opposite end of that, the investor might feel like, oh, how come you only offer me 5? And I heard you offered this person 6 and this person 7. Why is that change? And then your name, your brand, your recognition as a private money, they're like, I don't want to work with you.
Right. Well, that's why it's so important. We pay all of our private lenders the exact same thing. And, private lenders, they talk among themselves. And so I want to be fair and pay the best interest rate that I can to every one of our private money lenders.
Okay. And then let's say you're going to go as a private money investor, you have this note right here, and then you're working with escrow company, you're working with agencies, and they have all their fees involved, everything involved. And you guys, how do you guys step into that? You just provide the promissory note and then the money goes from the private investor to escrow? Or does it go to the person first and then it goes to escrow?
So you're talking about at the point of purchase?
Yeah.
Yeah. So the point of purchase, the private money lender wires their funds to escrow. Most states use a title company. North Carolina uses real estate attorneys. But whoever your closing agent is, the private money lender wires their funds to the trust account, right?
Okay. Yeah.
And then no funds are dispersed until after closing and everything is recorded on public record.
Okay, that's good. That's a good safety net too for the investors, so they can say, hey, you're not giving me the money directly. What we're going to do is we're going to purchase property. Here's the kind of things I'm looking for, and here's a dollar amount, 500,000, for example. You're going to wire your funds into escrow, and there's a promissory note. Here's all the terms we agreed upon. They reviewed it. Your real estate attorney reviewed it, and when we close, they'll get the 500K, and it pays everything out, and that way your money is protected from me, for example, from us. So that way I'm not just taking your money, running away, and going somewhere, right?
Correct. Yeah, everybody, like that promissory note, that deed of trust, that's on public record before any monies are dispersed to me, the borrower.
Yeah. And for you, investor, just to feel safe, money's recorded, it's in the public records. And if you actually lost your note, you have a copy in the public records here, and I am paying you this amount per month, whatever our terms we agreed upon at 8% interest rate. And there's no fees on it, origination fees. Let's say I give you a minimum 6 months, so we're going to pay X amount per month for 6 months, and after that I could, if I sold the property, give you your money back. Otherwise we could continue on for 2 years, like you said, 5 years for if you have retirement funds. And then how often go ahead.
Yeah, the key is making sure that note stays collateralized
To the property.
So if I cash out on a property, then we can't use that same property as the collateral because it got sold to a buyer, right, from us. But I can do what's called a substitution of collateral or a loan modification. If I'm purchasing another property, I already have a property that's got equity in it, then I can recollateralize that note, keep the note in play. The private lender doesn't miss out on any interest, and we're just doing the loan modification to change the collateral that's backing that note.
Okay, nice. Let's explain it in simple terms. Basically, you're saying that I have property 1 here and I'm going to sell it, but in the lender investor here has this money here, and I can actually use the same money. So I can substitute property number 2 to collateralize against that one while I'm keeping the same amounts here, and we can keep continuing together on. I don't need to redo a whole brand new note with you.
That's correct. That's correct.
That makes total sense. And how often do people flip properties right now, and how do the investors feel about it when they get their money back? Like, how long does it take usually for someone to get their money back?
Well, they don't want their money back.
Yeah.
they want to keep their money invested. But on our flips these days, the money stays invested on average now about 9 months to a year, because we have lots of projects going on, and a property might sit there for 3 months or so before the renovation actually starts. And, you know, when we have a new private lender and we're getting ready to pay them off, inevitably they'll say, can't you just keep the money? And the answer is no, I can't keep the money unless I can collateralize it with another property and keep you protected.
Okay, and let's add 2 things to that too. Let's say this, I'm the investor. Hey Jay, I actually want my money back. I found a new deal for myself. I need the money back. Can you give it to me now?
So in the note, we give what's called a 90-day call option. So that means if the private lender wants to call their note due early, prior to the length of the note coming due, all they got to do is give us a 90-day notice, and that gives us plenty of time to replace that private lender's money with another private lender's money.
Okay, that makes sense. It makes them feel better. Like, I have some form of liquidity, and hopefully the property is still growing, has equity, and the person's remodeling. And if I needed my money back just in case, I can ask for I can call the loan, and then you would try to replace it. What happens if you couldn't replace the money?
Well, that's why we don't borrow more than 75%. Of the after repaired value. So if they call the note due and I don't have another private lender's money, then a couple of things can happen. One, I can reduce the price. I can slash the price and do a quick sale, and that would make them whole, right? Or I can deed them the property. Say, look, if you're going to call the note due, I haven't finished the renovations. I don't have any other private money. So here's the property. Here's the keys.
Okay.
Yep.
So that's a way for them to also feel like, as the buyer, okay, you want the property back? Here you go. I can't give you your money back. We're trying, but you told me 1 year, 2 years, but now you're asking it for 6 months. You know, that's not there because the property's still being rehabbed. Okay, here's the property. So that's good for them too. Is there anything else for people to be aware of to learn more about private money, like how things to think about, things to ask? And it's probably inside your book, right?
So we cover it from A to Z in the book at jconner.com/book. I will give out a warning to real estate investors who have not borrowed private money before. Be aware of the scams that are on the internet and on Facebook. If you have a supposed private lender that is offering money at too good to be true low rates, that's a red flag. And if they ask you to send money to them for an origination fee or a processing fee before they fund your deal at your real estate attorney's trust account, run the other way. That's a scam right there. You never give a private money lender money up front. Never.
Okay. That's really good to be aware of, because that's one thing I think people think about too. Like, how do I know who these people are and how the money is actually legit and like, and like you said, scams. So, and then who do they review these contracts with? Like
their attorney. Are you talking about the private lender?
Yeah, or the borrower. Yeah.
Only documents are the promissory note and the deed of trust or the mortgage and the insurance policy and the title policy. Those are the only documents that take place during a closing. Interesting. Excuse me. In all these years, I've never had a private lender want to have their attorney review the documents because my attorney draws up the documents. I don't draw up the documents, but there's certainly nothing wrong with that. If the private lender wants to have their attorney review the documents, have at it, because it's all standard documents that we use.
Okay, perfect. Okay, I think that's a really great information regarding private money lending, and actually really helpful that you're on this podcast helping agents and investors understand how to use private money, how it's different from traditional lending, and that there's actually a lot of options open. And the only caveat is just watch out for any scams out there. But like if you have standard contracts and you understand what's going on and how to use it, and you can do basic calculation on, does this make sense at 8% rate and these terms with no origination fee versus 6% rate with a 1 to 2 point origination fee, or versus a residential rate, and basically if I qualify. And as long as you can calculate the difference between holding time and remodeling time, which one makes more sense? And for most people, they might go towards private money lending at this point in age, especially when the rates are so high. It might make more sense. So for anyone who's looking for more information, how do they learn more about you and how to connect with you?
Yeah, well, that's the best way right there is just order up my book. I got all my contact information in here, where to get the money now, and you can get the book for free. Just cover shipping at Jayconner, Jayconn book. I also just recently put together my Private Money $1 Million Script collection that answers any question a private lender has, and you can download for free that very first script. It's called the Curiosity Opener. Real estate investors want to know how to start conversations. Well, you can pick up that at Jayconner, Jayconner.com/scripts. And then finally, Matthew, 3 times a year, and the next one's coming up right around the corner, I do a live event in person. It's called the Private Money Conference. Not another event like it on the planet. And you can check out what happens at the Private Money Conference by going to www.jayconner.com/event, and you can register right there. It's a $3,000 event, but because you're listening to Matthew's podcast, you get to come for free with a simple $97 registration fee. That's jayconner.com/event, and I'd love to meet you in person.
When the bank says no, most agents freeze, not because they're incapable, but because no one ever showed them another option. The agents who last don't rely on just one system. They understand leverage, funding, and how to move forward when the path changes. If you want to become the agent's clients trust when it matters most, visit agenthustlenetwork.com. We'll link everything in the show notes. And if this conversation brought clarity to something you've been wrestling with, send it to someone who needs to hear it. Thanks again for listening to the Truth About Real Estate podcast. We'll see you guys in the next episode.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/moneyguide. That's JCONNER.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jayconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.